Hello, small business owners. This is Ed from SOS Bookkeeping. Today, we're going to go over the basics of the balance sheet. Now, the balance sheet is for a specific time, a point in time, a snapshot at a specific period of time. Unlike the income statement, which is for a period of time, this is just on a single date. The two are connected, though, and I'll show you why in just a moment. But the balance sheet is made up of three primary components: the assets, liabilities, and then owner equity. And assets might be cash on hand, accounts receivable, equipment, other types of assets of that sort. Liabilities would be accounts payable, maybe tax payable, that you've collected but you owe. It could be loans that you've taken out that you owe on. So different types of liabilities. And then the owner equity is what's left over. So the formula is assets minus liabilities equal owner equity. And owner equity is broken into a couple of different categories depending on your business type. The key to it is it's called a balance sheet because it has to balance. So all those components have to balance, and also your cash assets have to balance with your bank statement. So that may vary a little bit depending on if you're using the cash or accrual accounting method, which we'll discuss in a different video. But there's ways, other accounts that are added to offset that to make those balance. So they have to balance as well. So that's why it's called a balance sheet. So let's take a look at a balance sheet, and we'll go over some of the key components of it. So this is a sample of a balance sheet for a demo company for the first quarter of 2024. And it doesn't have all the components, but it'll give you a good idea. So let's start with the assets. And assets can be broken into two primary areas, would be your current assets. Well, actually three, would be your current assets, your non-current or long-term assets, and fixed assets. So this doesn't have any long-term assets or non-current assets. So some call it on this, but that would be like a loan that you've given out, maybe to an owner or a partner, and it's payable over a period of greater than 12 months. And that's the difference. Current assets are assets that are liquid or available within 12 months. And long-term assets are those that are available at longer than that. For instance, a CD, if the company has a CD maybe for 24 months or 5 years, that would be under the long-term assets. So in the current assets, you have cash and cash equivalents, so a checking account. So in this case, $9,100 and almost $9,200. I'm going to do a quick update here. Let's get rid of the decimal points. We don't need those. So about $9,200 in cash, and any other that, if there was a savings account, investment account, or any other liquid account that would be included in here as well. And then accounts receivable. So it's not cash, but it is accounts receivable and will soon hopefully turn into cash, $9,700. And again, these are accounts receivable that are expected to be received within 12 months. You may have contracts over an extended period of time, and that would be in your long-term assets. So then you have your fixed assets, which is equipment, manufacturing equipment, other types of hard assets, trucks, or other things that you may have. In this case, it has computer equipment and office equipment. So pretty simple. With their this is not their book value, this is their depreciated value. And total assets or total fixed assets, and then your total assets of $21,265. So that's your total assets. Then let's go to your liabilities. And again, liabilities would be broken into current liabilities and long-term liabilities. A long-term liability might be a loan that you've taken out that is payable over more than 12 months, for example. So here we have accounts payable, which are payments due to vendors. We have historical adjustment, which is something you won't use very often. It's used to help balance the balance sheet. And it may include things like currency adjustments. If you're dealing internationally, maybe if you're dealing in something that like oil or something that changes in value on a daily basis, but that won't be used too much. And then sales tax, a sales tax you've collected, but you haven't paid yet. So it's a liability on your books. So that gives us all the total current liabilities, which is your total liabilities in this circumstance. So as we stated at the beginning, the formula is assets, which is this number, minus liabilities, which is this number, equals owner equity, which is this number. Now, here's where the income statement and the balance sheet work together. So you'll see here in equity, it's broken down into two types. Current year earnings, which is negative $191. And if we click on that, that should take us to the income statement for that period. And let's see if it does. Income statement, it does. Okay, so this is why these two are connected and why I like to look at the income statement first, then the balance sheet. Sometimes you'll see the balance sheet first, but really you start the income statement because the result of that flows over to your balance sheet. So let's go back to the balance sheet and continue on. So we've taken that number, the current earnings, which is negative 191, and that leaves retained earnings of $5,276. So retained earnings would be earnings that have accumulated over previous periods, and you've retained those earnings. So you can see that number is greater than the total equity because you had a loss for the current earnings period, the first quarter of the year. So it gives you a total equity of the $5,084. And then the total liabilities and equity combined equals the $21,265, which is equal to $21,265. So it is in balance. Then what we will do also as part of our responsibility for your monthly reconciliation and reporting is to make sure that your checking accounts balance with your balance entered on the books in your balance sheet equal the cash in your bank accounts. Now, if you're using the accrual basis, that will differ a little bit, but because we're registering assets before they're actually collected in that case. But these will balance one way or another. So that's the essence of a balance sheet. It gives you a really good snapshot of where you are, and over time you can do a comparison on if you're using the software, some accounting software. By the way, this is Xero, and this is their basic program, which is $15 a month. So there's no reason to not use a bookkeeping software. You can compare periods, so you can see your progress either forward or backward. Hopefully it's forward, and how you're progressing in increasing your equity and increasing your retained earnings. So I hope that gives you a pretty good idea of the basics of a balance sheet. And if you have any questions, just post them in the comments and I'll be happy to answer them. Wishing you all the best.